Warren Buffett's renowned 10-year rule has become a cornerstone of investment wisdom, encouraging individuals to approach the stock market with patience and a long-term perspective. The essence of this rule is simple. Only invest in a company if you would be comfortable holding its stock for a decade, regardless of market fluctuations. This philosophy has resonated with countless investors, offering a sense of stability amid uncertainty. But as markets evolve and new investment strategies emerge, an important question arises. Is Buffett's advice truly a timeless filter for sound decision-making? Or could it become a potential trap for those navigating today's dynamic financial landscape? In this section, we'll explore the enduring appeal of the 10-year rule and examine whether it still holds up in the modern era. The popular interpretation of this quote centers on the idea of perseverance in investing. Many investors view it as a rationale for holding on to their stocks, even during periods of sharp declines and heightened market volatility. The quote is often cited as encouragement to remain patient, trusting that markets will eventually recover over time. This perspective suggests that selling during downturns could mean missing out on future gains. As a result, the quote has become a guiding principle for those who advocate for long-term investing, emphasizing resilience in the face of uncertainty. For countless individuals, it serves as reassurance to stay the course, regardless of short-term market fluctuations. The term HODL originated from a misspelled word in a Bitcoin forum post, but it quickly evolved into a rallying cry within the cryptocurrency community. It stands for "Hold on for dear life" and encourages investors to resist the urge to sell during market downturns. Over time, HODL has become more than just advice. It acts as a psychological shield against panic selling, fostering a sense of solidarity among holders. The mantra romanticizes the idea of long-term commitment, often urging individuals to remain passive and ignore short-term volatility, regardless of changing circumstances. This approach can instill confidence, but it may also discourage critical evaluation of market conditions. As a result, HODL has shaped investor behavior, sometimes prioritizing steadfastness over strategic decision-making. Many investors rely on simplified versions of Warren Buffett's advice, believing that following a few popular quotes will guarantee success. However, this incomplete interpretation can be risky. By focusing only on surface-level wisdom, investors may overlook important nuances and context, leading to poor decision-making. This tendency gives rise to intellectual traps, where individuals misapply Buffett's principles without fully understanding their limitations or relevance. Such traps can result in overconfidence, misjudged investments, and missed opportunities. Recognizing these pitfalls is crucial for anyone seeking to benefit from Buffett's teachings in a meaningful and effective way. Warren Buffett's famous quote about only investing in businesses you understand is often cited as a guiding principle. However, its true meaning is frequently misunderstood. Rather than serving as the initial filter for investment choices, Buffett uses this concept as a final checkpoint, applied only after thorough and rigorous analysis. It's not about limiting yourself at the outset, but about ensuring that, after deep research, you genuinely grasp the business's fundamentals and long-term prospects. This approach helps avoid superficial judgments and encourages investors to dig deeper before making decisions. By treating understanding as the last hurdle, Buffett ensures that each investment is backed by both knowledge and conviction. Warren Buffett is renowned for his unique approach to investing, which centers on analyzing businesses rather than merely picking stocks. Instead of focusing on short-term market trends or speculative gains, Buffett delves deeply into understanding the fundamentals of each company. He examines factors such as management quality, competitive advantages, and long-term prospects. This business analyst mindset allows him to assess the true value and potential of a company, rather than being swayed by market fluctuations. By prioritizing a thorough comprehension of the business itself, Buffett aims to make informed decisions that stand the test of time. His strategy emphasizes ownership and partnership, treating each investment as a stake in a real, operating enterprise. The 10-year rule emphasizes business fundamentals because these factors provide a reliable foundation for long-term success. Earnings and cash flow reflect a company's ability to generate profit and sustain operations over time, while competitive advantages help ensure resilience against competitors. Unlike market noise or hype, which can cause short-term fluctuations and distract from a company's true value, fundamentals offer a clearer picture of its financial health and future prospects. By focusing on these core elements, investors can make more informed decisions and avoid being swayed by temporary trends or speculation. This approach encourages patience and discipline, prioritizing sustainable growth over fleeting excitement. The margin of safety is a fundamental principle in investing, serving as a buffer against errors in judgment or unforeseen market shifts. Valuation plays a crucial role in determining whether an investment offers this protection. Warren Buffett has consistently emphasized that even the most exceptional businesses can become poor investments if acquired at inflated prices. He insists on purchasing companies only when their market value is significantly below their intrinsic worth, ensuring a margin of safety. Buffett's disciplined approach means he would never hold on to a great business if he paid an unreasonable price for it, as the risk of loss would outweigh the potential for long-term gains. This philosophy underscores the importance of careful analysis and patience in investment decisions. Ignoring valuation when investing can have serious consequences for long-term returns. A notable example is the Nifty 50 bubble of the early 1970s, when investors flocked to a group of popular blue-chip stocks, believing they could do no wrong. These stocks traded at extremely high price-to-earnings ratios, with little regard for whether their valuations were justified by future growth. When market sentiment shifted, many of these companies experienced significant declines, and investors who bought at the peak faced years of poor performance. This episode highlights the risks of chasing trends without considering whether an asset is reasonably priced. Overpaying for stocks, even those with strong fundamentals, can lead to disappointing results if future returns fail to meet lofty expectations. The 10-year rule is best understood as a thought experiment and a practical filter for making investment decisions, rather than a strict mandate to hold assets for a decade. Its purpose is to encourage long-term thinking and to help investors focus on quality and durability, not to dictate rigid holding periods. Before making any purchase, investors should ask themselves critical questions. Does this business have enduring competitive advantages? Will its products or services remain relevant over the next 10 years? Are the management and financials strong enough to weather market changes? By considering these factors, investors can make more informed choices, aligning their portfolios with long-term growth and stability. In today's fast-paced markets, investors often fall into the trap known as bag holding. This occurs when individuals cling to declining investments, hoping for a turnaround that may never come. The famous quote, "Time in the market beats timing the market," is sometimes misused to justify holding on to poor-performing assets. However, this mindset can be driven by loss aversion, where the fear of realizing a loss outweighs rational decision-making. It's important to recognize when an investment no longer aligns with your goals or shows little potential for recovery. Blindly holding on to failing assets can erode capital and hinder future opportunities. Being aware of this psychological pitfall can help investors make more objective choices. The idea of set it and forget it investing suggests that once you've made an investment, you can simply leave it untouched and expect positive results over time. However, this approach overlooks the dynamic nature of markets and industries. Prudent investors recognize that companies, sectors, and competitive landscapes are constantly evolving, which can impact the original reasons for investing. Regularly revisiting and verifying your investment thesis ensures that your portfolio remains aligned with current realities and future prospects. Ignoring these changes can lead to missed opportunities or unexpected risks. Staying informed and adaptable is essential for long-term investment success. Warren Buffett is known for his steadfast investment principles, but even he recognizes the importance of adapting to new circumstances. For instance, in 2020, Buffett made headlines when he sold all of Berkshire Hathaway's holdings in major airline companies. This decision came after the COVID-19 pandemic dramatically altered the long-term prospects of the airline industry. Despite previously expressing confidence in these investments, Buffett acknowledged that the future had changed in ways he could not have predicted. His willingness to reevaluate and act on new information illustrates that flexibility is essential even for legendary investors. By responding to shifting realities, Buffett demonstrates that successful investing often requires both conviction and the ability to pivot when necessary. Patience is often celebrated as a virtue in investing, but it can be mistaken for negligence when applied indiscriminately. Holding on to assets that consistently lose value over a decade is not a sign of disciplined investing, but rather a path to capital destruction. While patience involves thoughtful analysis and conviction, negligence ignores warning signs and changing market conditions. Investors who fail to reassess declining assets risk eroding their wealth, mistaking inactivity for wisdom. True investment success requires regular evaluation and the courage to make difficult decisions, not simply waiting and hoping for a turnaround. In the end, the difference between patience and negligence can determine whether an investor preserves or loses their capital. The prudent investor follows a disciplined approach, beginning with careful analysis of potential investments. This means thoroughly evaluating a company's fundamentals, competitive position, and long-term prospects before making any decisions. The next step is to buy only when the investment meets strict criteria, such as the ability to confidently hold it for at least 10 years. Here, the 10-year test serves as an active filter, guiding the investor to select businesses they truly believe in for the long run, rather than simply holding onto stocks out of habit. Finally, ongoing verification ensures that the investment continues to meet these standards over time. This method helps investors avoid impulsive decisions and focus on building a resilient portfolio. Prudent investing begins with a thorough analysis of the business in question. This involves examining financial statements, understanding the competitive landscape, and evaluating the management team's track record. Once a solid understanding is established, the next step is to purchase shares at a margin of safety, meaning the price paid is significantly below the estimated intrinsic value. This approach helps protect against unforeseen risks and market fluctuations. After the investment is made, ongoing verification of the original investment thesis is essential. Regularly reviewing company performance and industry trends ensures that the rationale for holding the investment remains valid. By following these steps, investors can increase their chances of achieving long-term, sustainable returns. True safety and peace of mind in investing are achieved through a deep understanding of financial markets and a disciplined approach, rather than by simply ignoring market volatility. Investors who take the time to learn about market cycles, risk management, and the principles behind their investments are better equipped to make informed decisions. Discipline in following a well-structured investment process helps to minimize emotional reactions to short-term fluctuations. Instead of fearing volatility, knowledgeable investors recognize it as a natural part of the market and use it to their advantage. This approach fosters confidence and ease, as decisions are guided by strategy rather than impulse. Ultimately, lasting security in investing comes from preparation and consistency, not from avoiding the realities of the market. It's easy to fall into the trap of oversimplifying Warren Buffett's famous words, using them as a shortcut for avoiding deeper thought. However, true understanding requires more than just repeating a quote. By rejecting lazy analysis and the misuse of Buffett's advice, we open ourselves to a mindset of profound examination and active ownership. This approach encourages us to dig beneath the surface, question assumptions, and take responsibility for our decisions. Embracing thoughtful analysis not only leads to better outcomes, but also fosters a culture of genuine insight and growth. The key lesson here is that successful investing is not just about holding assets for a fixed period, such as 10 years. Instead, it involves identifying rare opportunities where diligent research uncovers true value, regardless of the prevailing market sentiment. By focusing on deep analysis and understanding, investors can make informed decisions that are less influenced by short-term market fluctuations or popular opinion. This approach allows for greater confidence in one's investments, as choices are based on substance rather than noise. Ultimately, the emphasis is on quality and conviction, not simply on time. As we wrap up, your perspective matters. Share your thoughts on today's discussion and let us know which investing quotes you'd like to see analyzed in future episodes. Your suggestions help us create content that's both insightful and relevant. If you found this analysis valuable, consider subscribing for more deep dives into the wisdom that shapes successful investing. Together, we can continue exploring the principles that guide smart financial decisions.